Hey, what's up, stock compounders? Brad here. So, Seth Klarman, a couple years after the global financial crisis, wrote an incredible memo that I'm going to be highlighting today. But first, I want to show you how I found that memo. Today is the first day that I've been aware of it. So this is an email I look forward to every week. Just a quick plug for John at MOI Global. This MOI Global newsletter, it's really an email digest once a week that shares 11 articles we're reading. And this is one of the articles, Klarman's Forgotten Lessons, That's kind of what led to the video today. But I love every week to go through here. Usually I pick up a few of these articles, letters and commentaries from different fund managers, 5 videos we're watching this week, 5 podcasts we're listening to. So some of you who follow me know every Monday, usually most Mondays, I put out what I'm digging into this week. And most of those resources come from this email, So be sure to sign up for John's email. But let's dig in, to these forgotten lessons of 2008. Again, this is from Investment Talk. You can find him on Twitter. That's Connor. The Forgotten Lessons of 2008. Seth Klarman outlines the lessons that investors were quick to forget only 2 years following one of the greatest financial meltdowns in modern history. 2 years after the great financial crisis of 2008, Seth Klarman shared a memo explaining how he felt that investors were quick to forget the lessons learned from one of the greatest financial meltdowns in modern history. He would remark that these lessons were either never learned or else were immediately forgotten by most market participants. So what I did, I put a little Twitter thread together with these 20 investment lessons that have been forgotten and that are well worth remembering. So let's dig into this Twitter thread that I created. And please, if any of you are on Twitter, go find my thread, like it, retweet it, really helps. But let's dig in. So I added this, cover your assets, Because this is really about, how to protect your downside. It's about really having an orientation towards risk and managing risk as opposed to chasing returns, which obviously is a very important tenet for value investors. So the first one, things that have never happened before are bound to occur with some regularity. It's this black swan idea. You must always be prepared for the unexpected, including sudden, sharp downward swings in markets and the economy. Whatever adverse scenario you can contemplate, reality can be far worse. So what that reminded me of, Howard Marks saying, you cannot predict, you can prepare. So that's the first one. Number 2, when excesses such as lax lending standards become widespread and persist for some time, people are lulled into a false sense of security, creating an even more dangerous situation. In some cases, excesses migrate beyond regional or national borders, raising the ante for investors and governments. These excesses will eventually end, triggering a crisis at least in proportion to the degree of the excesses. Perhaps a timely warning. Correlations between asset classes may be surprisingly high when leverage rapidly unwinds. So, risk, this is how I summarize this, risk tends to be highest when nobody is thinking about risk, When people just kind of forget about risk. It doesn't matter anymore. It's all about chasing returns. And Howard Marks talks a lot about this as well. Number 3, nowhere does it say that investors should strive to make every last dollar of potential profit. Consideration of risk must never take a backseat to return. Conservative positioning entering a crisis is crucial. It enables one to maintain long-term oriented, clear thinking and to focus on new opportunities while others are distracted or even forced to sell. Portfolio hedges must be in place before a crisis hits. One cannot reliably or affordably increase or replace hedges that are rolling off during a financial crisis. Okay? This is obvious, but whatever. The best time to prepare for a crisis is before a crisis. And usually before a crisis, going back to the last one, it tends to be a time of, where is it? The end of a long bull market, right? Where people are lulled into a false sense of security. That tends to be the time you really need to be preparing for a crisis. So it's tricky, very tricky. Number 4, risk is not inherent in an investment. It is always relative to the price paid. Uncertainty is not the same as risk. Indeed, when great uncertainty drives security prices to especially low levels, they often become less risky investments. And the whole idea here is that the real risk is permanent loss of capital, and the likelihood of permanent loss of capital depends on that relationship between value and price paid. Okay? If you can pay a very low price for something that seems really risky to everyone, but the value is actually a little bit higher than that price paid, well, it's much less risky. So risk needs to be considered in both value and price in that relationship. Number 5, do not trust financial market risk models. Let me blow this one up a little bit. Reality is always too complex to be accurately modeled. Attention to risk must be a 24/7, 365 obsession with people, not computers, assessing and reassessing the risk environment in real time. Despite the predilection of some analysts to model the financial markets using sophisticated mathematics, the markets are governed by behavioral science, not physical science. Okay? So risk cannot be modeled using sophisticated mathematics because the markets are governed by human behavior. Okay? Incredibly important point here. And Klarman, I think it was last year, he pointed out he thinks the best book he's ever read on investing was Thinking Fast and Slow. Okay? It's a book about human behavior, how people think. And that to Klarman is a big edge as an investor, if you can really understand investor psychology. So the other point here is don't try to outsource risk management, okay? You're not going to find somebody who can model it for you. You have to take your own responsibility for understanding what the risks are in your portfolio. Do not accept principal risk while investing short-term cash. The greedy effort to earn a few extra basis points of yield inevitably leads to the incurrence of greater risk, which increases the likelihood of losses and severe illiquidity at precisely the moment when cash is needed to cover expenses, meet commitments, or make compelling long-term investments. Only accept risk when it's adequately compensated. Now, there's no reason, with your cash to chase an extra 1 or 2% if you're incurring this risk that can really, cut you off at the legs when you need it most. Okay, when you either need it most or you could most benefit from having access to that capital when everything's going on sale. Number 7, the latest trade of a security creates a dangerous illusion that its market price approximates its true value. This mirage is especially dangerous during periods of market exuberance. The concept of private market value as an anchor to the proper valuation of a business can also be greatly skewed during ebullient times and should always be considered with a healthy degree of skepticism. So the idea here, don't confuse price and value, which is especially difficult during long periods of market exuberance. Okay? The price in the markets is not the same as the value of the business most of the time. So you got to know the difference, right? Don't get lulled into this illusion, oh, this must be what it's worth, especially during periods of market exuberance when things are quite obviously overpriced, in hindsight at least, especially looking back a year or 2 years ago. It's pretty obvious. A lot of the stocks in the U.S. market got bid up to crazy levels. Number 8, a broad and flexible investment approach is essential. During a crisis, opportunities can be vast, ephemeral, and dispersed through various sectors and markets. Rigid silos can be an enormous disadvantage at such times. And Klarman talked about this idea of silos in his talk last year at Harvard, which a lot of us probably weren't able to see because somebody posted it and it got pulled very quickly. But in that talk, he did talk about silos. The greatest opportunities during a crisis often show up between the silos. Okay? Something to really meditate on. 9, you must buy on the way down. There is far more volume on the way down than on the way back up, and far less competition among buyers. It is almost always better to be too early than too late, but you must be prepared for price markdowns on what you buy. Particularly for large buyers, buying on the way down offers a huge advantage. Number 10, financial innovation can be highly dangerous, though almost no one will tell you this. You've been told, right? You guys have been warned. New financial products are typically created for sunny days and are almost never stress tested for stormy weather. Securitization is an area that almost perfectly fits this description. Markets for securitized assets, such as subprime mortgages, completely collapsed in 2008 and have not fully recovered. Ironically, the government is eager to restore the securitization markets back to their pre-collapse stature. So, my summary, financial innovations arise from greed, the desire to squeeze even more juice out of a bull market. Can they survive in an environment of fear? Okay. There's probably a lot of risk built into these assets that can only be seen when the tide goes out. So be very careful. Probably should just ignore these things altogether. Number 11, ratings agencies, let me blow this up here, are highly conflicted, unimaginative dupes. They're blissfully unaware of adverse selection and moral hazard. Investors should never trust them. Very strong words from Seth Klarman. You can tell he has a bit of history there. Do not outsource your assessment of risk to ratings agencies. Obviously, it's their job, right, to rate the creditworthiness of companies. But if you lose money, they're not going to pick up the bill. Okay, you really have to take it upon yourself to assess the risk of your investments and not outsource that to ratings agencies. I mean, we all know what happened in 2008. You know, how these subprime mortgages, right, the CDSs, how they were rated, right? They were rated great by the ratings agencies. Well, it shows you what that did. Don't trust, don't outsource your risk management. Number 12, be sure that you are well compensated for illiquidity, especially illiquidity without control, because it can create particularly high opportunity costs. Meaning, you know, if the market's crashing, you're in something illiquid, you really have no ability to get out of it, to cash out and buy something, you know, that's more compelling because of the crash. Don't take on illiquidity risk without adequate compensation for it, which is a common theme. Don't take on risks without being compensated. Understand what the risks are. Number 13, at equal returns, public investments are generally superior to private investments, not only because they are more liquid, but also because amidst distress, public markets are more likely than private ones to offer attractive opportunities to average down. Public investments come with the advantage of partnering with a manic depressive Mr. Market. The depressive side can offer great buying opportunities to the owner-oriented investor. Basically, when markets crash, public markets are going to get hammered more than private markets, which is great if you're a buyer, right? So keep that in mind. Number 14, beware leverage in all its forms. Borrowers, individual, corporate, or government, should always match fund their liabilities against the duration of their assets. Borrowers must always remember that capital markets can be extremely fickle and that it is never safe to assume a maturing loan can be rolled over. Even if you are unleveraged, the leverage employed by others can drive dramatic price and valuation swings. Sudden unavailability of leverage in the economy may trigger an economic downturn. So, a lot has been said about leverage, especially by the guru I follow, Monish Pabrai. In order to win the game, you must stay in the game. So beware of leverage. Beware of using leverage to try to get ahead faster. Because if you're doing that, you're probably only focusing on the returns, right? On the upside. Beware of how that leverage exposes you on the downside. Number 15, many leveraged buyouts are man-made disasters. When the price paid is excessive, the equity portion of an LBO is really an out-of-the-money call option. Many fiduciaries placed large amount of the capital under their stewardship into such options in 2006 and 2007. Risk is the relationship between value and price paid. Okay, this comes up again and again. The price paid is excessive, your risk is very high. Number 16, financial stocks are particularly risky. Banking in particular is highly leveraged, extremely competitive, and challenging business. A major European bank recently announced the goal of achieving a 20% return on equity within several years. Unfortunately, return on equity is highly dependent on absolute yields, yield spreads, maintaining adequate loan loss reserves, and the amount of leverage used. What is the bank's management to do if it cannot readily get to 20%? Leverage up, hold riskier assets, ignore the risk of loss. In some ways, for a major financial institution, even to have an ROE goal is to court disaster. Financial stocks are particularly risky as leverage is usually inherent in the business model. Okay, so be very careful. 17, we've got to blow this one up because it got distorted. Having clients with a long-term orientation is crucial. Nothing else is as important to the success of an investment firm. Okay, big statement. Nothing else is as important as partnering with long-term oriented investors. Having clients with a long-term orientation allows the fund manager to invest with a long-term orientation. Having clients that pile in at the top and pull out at the bottom forces the fund manager to do the same, right? Just crushes returns in a negative way. Number 18. When a government official says a problem has been contained, pay no attention. Okay? Again, do not outsource your thinking about risk management, especially to government officials. Government officials are incentivized by re-election prospects, not by managing the risk in your portfolio. You must think for yourself. One of the challenges about living in the U.S. with these 2- and 4-year election cycles is it's really hard for governments to have a long-term orientation, right? Because it's very unpopular. It can be very unpopular to make decisions that really benefit from time, more than 4 years. So you got to understand that misalignment of incentives. Number 19, the government, the ultimate short-term oriented player, cannot withstand much pain in the economy or the financial markets. Bailouts and rescues are likely to occur, though not with sufficient predictability for investors to comfortably take advantage. The government will take enormous risks in such interventions, especially if the expenses can be conveniently deferred to the future. Some of the price tags in the form of backstops and guarantees whose cost is almost impossible to determine. It is not the job of the government to manage long-term risk. It is the job of the investor to manage long-term risk. Beware of this misalignment. Finally, number 20. Last one. Almost no one will accept responsibility for his or her role in precipitating a crisis. Not leveraged speculators, not willfully blind leaders of financial institutions, and certainly not regulators, government officials, ratings agencies, or politicians. When a crisis hits and your portfolio takes a dive, it's human nature to point the finger at someone else, right? Who can I blame? Human nature. The crisis may not have been your fault, but the impact it has on your portfolio is your fault. Take responsibility for managing risk in your investment portfolio. Big lessons here. 20 big lessons from Seth Klarman. Big shout out to Seth Klarman for sharing his wisdom with the world. Hope you guys enjoyed this. Again, if you're on Twitter, please go give it a like, give it a retweet. Really helps me out. And let me know in the comments, what is kind of the biggest takeaway lesson for you right now with where we are in the markets, with where you are in your investment journey? I'd love to hear what the biggest one is for you. All right, guys, without further ado, thanks for watching, and I'll see you all in the next one. Take care.